Something just shifted in the silver market, and it didn't come from a central bank, a rate decision, or a major Western exchange. It came from a place most people rarely associate with global finance, Greenland. And the reason this matters is not because of headlines, but because of what it quietly exposed about how fragile the silver market really is. This isn't a story about price targets or sudden spikes. It's about supply, access, and how quickly confidence can change when the system realizes something it assumed was stable isn't. For years, silver has been treated as abundant, available, easy to source when needed. That assumption allowed markets to operate with confidence that any short-term imbalance could be smoothed out through logistics, contracts, or timing. But Greenland's role in the global silver supply chain challenged that belief in a way most investors weren't prepared for. What happened wasn't loud. There was no dramatic announcement. Instead, supply constraints tightened, premiums behaved differently, and delivery expectations shifted. These are the kinds of changes that don't show up immediately on charts, but they matter far more than a single price candle. If you're here to understand markets before they become obvious, make sure you're subscribed. This channel focuses on structural shifts, the moments when systems start behaving differently, long before headlines catch up. Greenland sits at a critical intersection of geography and resources. When access becomes restricted or slowed, whether by environmental conditions, logistics, or operational constraints, the ripple effects don't stay local. They move outward, quietly into markets that rely on consistency. Silver markets depend heavily on confidence in supply chains, not just total supply, but timely supply. When timing becomes uncertain, behavior changes fast. Buyers secure metal earlier. Sellers become less flexible. Premiums stop behaving normally. And paper markets, which assume smooth delivery, begin to feel pressure. This is where the disconnect starts. Paper silver trades on the assumption that physical silver will always be available somewhere, sometime, at a reasonable cost. But when real-world constraints challenge that assumption, the system has to adjust, and adjustments don't happen evenly. They show up as stress. What caught the attention of experienced market watchers wasn't panic, it was inconsistency. Spreads widened unexpectedly. Physical premiums decoupled from futures prices. Moves that should have relieved pressure didn't. That's a signal that something deeper is changing. Greenland didn't kill the silver market. It forced it to confront reality. It reminded the system that physical supply is not infinite, not frictionless, and not always responsive to financial expectations. And once that reminder sinks in, behavior shifts everywhere else. This is why silver suddenly feels tighter, even when volumes look normal. It's why price reactions feel sharper. And it's why explanations that used to make sense now feel incomplete. The system is recalibrating around a new constraint, and recalibration is never smooth. We're now at the very beginning of that process. Most people still see this as noise, as temporary, as something that will resolve itself quietly. But history shows that when supply assumptions break, markets don't simply go back to normal, they adapt. And adaptation changes the rules. What makes this moment especially important is how quietly it's unfolding. There's no panic, no obvious crisis, and no single data point screaming for attention. That's exactly how structural shifts tend to begin. The silver market is still trading, prices are still moving, and most participants are behaving as if the old assumptions still apply. But beneath that surface, behavior is already changing. The first thing to understand is that silver doesn't operate on headlines. It operates on confidence in logistics, delivery, and timing. When a part of the supply chain becomes less predictable, even temporarily, it forces a reassessment that ripples far beyond the original source. Greenland's role may seem remote, but markets don't care about geography. They care about reliability. When access tightens or delivery windows become uncertain, physical buyers don't wait for confirmation. They act early. They secure material ahead of need. They become less price-sensitive and more continuity-focused. That shift alone can alter market dynamics because it removes supply from circulation before financial markets register the change. This is where the paper market starts to feel pressure. Futures and derivatives are built on the assumption that physical supply will appear when needed. Not necessarily immediately, but predictably. When that predictability weakens, even slightly, hedging becomes more complex. Positions that were once routine require closer monitoring. Risk managers begin asking questions they didn't need to ask before. What's important here is that none of this requires a shortage in the traditional sense. The market doesn't need to run out of silver. It only needs to become less confident about when and how silver can be delivered. Timing risk is enough to change behavior. And timing risk is exactly what logistical disruptions introduce. As this plays out, familiar mechanisms start to underperform. Normally, rising prices encourage selling. Normally, pullbacks relieve pressure. But when physical demand is driven by necessity rather than speculation, those mechanisms weaken, sellers hesitate, buyers step in earlier, the balance shifts. This is why observers are noticing that silver no longer reacts the way it used to. Moves feel compressed, reversals feel temporary. Volatility doesn't dissipate cleanly. These aren't signs of excitement. They're signs of adjustment. Another subtle signal is how premiums behave. Physical premiums begin to detach from futures pricing. Not dramatically at first, but persistently. That persistence matters. It tells you that the market is struggling to reconcile financial expectations with physical reality. And when that reconciliation fails, the system has to reprice risk. Greenland's impact matters because it highlights a vulnerability that was always there but rarely tested. The silver market depends on a complex web of extraction, processing, transport, and delivery. When even one link in that chain becomes constrained, the entire system feels it. Not instantly, but inevitably. This is also where narratives start to diverge from experience. Commentators focus on charts and technical levels. What we're seeing now is the early stage of that realization. It's still subtle enough to be dismissed. The silver market hasn't broken, it's tightening. And tightening systems don't announce themselves loudly. They reveal themselves through behavior. We're moving deeper into that phase now. As the market absorbs this tightening, a new pattern begins to emerge. One that's easy to miss if you only watching price. The most important changes aren't happening on the chart. They're happening in how participants respond to uncertainty and how quickly that response is triggered. In stable markets, hesitation is common. Traders wait for confirmation. Institutions give moves time to develop. Liquidity providers step in with confidence, knowing that dislocations tend to correct themselves. That behavior relies on trust. Trust that the system will behave tomorrow the way it behaved yesterday. That trust is now being tested. When supply reliability comes into question, even indirectly, patience shortens. Decisions that once took days are made in hours. Risk that was once tolerated is reduced preemptively. This doesn't show up as panic selling or dramatic buying. It shows up as caution layered on top of caution until the market's rhythm changes. Silver is especially sensitive to this because it sits between two worlds. It's traded like a financial asset but demanded like a real-world input. When the physical side asserts itself, the financial side has to adapt. And adaptation isn't symmetrical. Some participants adjust faster than others, creating uneven pressure across the market. This is where leverage becomes a stress multiplier. Paper markets rely on the ability to roll positions forward smoothly. When timing becomes uncertain, that process becomes more fragile, margin requirements tighten, volatility thresholds are hit sooner. Positions that were previously low maintenance suddenly require active management. Importantly, this isn't driven by fear, it's driven by probability. Institutions don't wait for worst-case scenarios to materialize. They respond when the likelihood of disruption increases, even modestly. That response, multiplied across many players, alters market behavior. Another signal appears in how quickly reactions cascade. Small moves provoke outsized responses. Levels that once acted as buffers no longer slow momentum. This doesn't mean the market is out of control. It means the shock absorbers are less effective. And when shock absorbers weaken, even normal bumps feel sharper. What complicates this further is that traditional explanations stop working. Analysts look for news to justify moves, but the moves aren't news-driven. They're structure-driven. They reflect accumulated tension rather than fresh information. That disconnect leads to confusion for those relying on headlines to make sense of price action. Greenland's role in this broader picture is symbolic as much as practical. It represents a constraint that can't be smoothed away with contracts or assumptions. Geography, climate, and logistics impose limits that financial models don't easily accommodate. When those limits become relevant, even briefly, they force a recalibration. This is why the market's reaction feels different from a typical supply scare. It's not a rush in one direction followed by relief. It's a gradual tightening of behavior. Participants become more alert, less forgiving, more sensitive to any sign of imbalance. Over time, this sensitivity feeds back into price discovery. Markets become more reactive not because they're unstable, but because they're adjusting to new information about reliability. That adjustment doesn't happen in a straight line. It unfolds through periods of calm punctuated by sudden moves. This is the stage where many observers misjudge what they're seeing. They expect clarity and get ambiguity. They expect resolution and get persistence. But persistence is the clue. When a market continues to behave differently long after the initial trigger, it's telling you something fundamental has shifted. We're now firmly in that phase. The silver market isn't responding to a single event anymore. It's responding to a new set of constraints, and once constraints change, behavior follows. As this adjustment deepens, the most important shift is not what silver does on any single day, but how the market expects silver to behave going forward. Expectations are powerful. They shape positioning, risk tolerance, and the willingness to provide liquidity. When expectations change, the market's character changes with them. At this stage, participants begin operating with a different baseline assumption. Instead of assuming supply will smooth out any disruption, they assume friction is possible. Instead of assuming pullbacks will relieve pressure, they assume pressure may persist. That subtle change alters how decisions are made across the board. Liquidity, which once felt automatic, becomes selective. Market makers still participate, but with tighter parameters. They demand clearer signals before committing size. They pull back more quickly when conditions feel uncertain. This doesn't eliminate liquidity, but it makes it less forgiving. Prices move further on less volume. Moves feel more abrupt, even when nothing dramatic appears to be happening. Silver's behavior during this phase often confuses casual observers. On some days it looks calm. On others, it reacts sharply to relatively small inputs. This inconsistency isn't random. It reflects a market that is recalibrating how much risk it's willing to absorb without adjustment. The threshold for reaction has shifted lower. Another important change is how participants think about time. Under stable conditions, time works in your favor. Positions can be managed gradually. Adjustments can be made incrementally. But when uncertainty around supply and delivery increases, time becomes a liability. Participants prefer to act sooner rather than later. That urgency compresses decision-making and amplifies reactions. This compression is especially evident around events that interrupt normal market flow, holidays, weather disruptions, or logistical bottlenecks. Each interruption carries more weight than it used to, because the system has learned that continuity cannot be taken for granted. That lesson lingers long after the original trigger fades from memory. Greenland's role continues to echo through this process, not because it dominates the silver market, but because it exposed a vulnerability that had been largely theoretical. Once a vulnerability is experienced, it stops being abstract. It becomes part of how risk is evaluated going forward. This is also where the gap between perception and reality widens. Public narratives focus on price levels, technical indicators, and short-term catalysts. Meanwhile, participants closer to the physical market focus on lead times, availability, and reliability. Both perspectives coexist, but during periods of adjustment, the physical perspective carries more influence. Over time, this influence reshapes price discovery. Markets become less responsive to paper pressure and more sensitive to signals tied to actual flow. That doesn't eliminate speculation, but it changes its effectiveness. Moves driven purely by positioning struggle to sustain themselves without confirmation from physical behavior. Another subtle but important development is the way confidence is rebuilt. Confidence doesn't return all at once. It returns conditionally. Participants regain comfort only after repeated confirmation that the system can function under the new constraints. Until then, caution dominates. This prolonged caution is what gives the market its uneasy feel. It's not fear. It's vigilance. Everyone is watching more closely. Everyone is quicker to adjust. That collective alertness makes the market more reactive, even when underlying conditions are relatively stable. What's often misunderstood about this phase is that it doesn't signal imminent collapse. It signals transition. The system is learning how to operate with a different set of assumptions. That learning process is inherently uneven. Some participants adapt quickly, others lag behind. The resulting mismatch creates volatility. We're now in the middle of that learning process. The old rules haven't disappeared, but they no longer provide certainty. New rules are forming, but they aren't fully defined yet. The market exists in between, functioning but sensitive. And history shows that once a market enters this in-between state, the final adjustment isn't about returning to comfort. It's about accepting a new normal. As this transition reaches its final stage, the most important thing to understand is that markets don't announce when they've permanently changed. There is no bell, no headline, no single moment that confirms the shift is complete. Instead, the confirmation comes through behavior that no longer reverts back to what people expect. By this point, the silver market is no longer reacting to Greenland as a one-off disruption. Greenland has already done its work. It exposed a weakness that existed long before anyone noticed it. What follows now is the system adjusting itself around that weakness. Participants begin operating with a new internal rule set. They don't say it out loud, but it shows up in decisions. Positions are smaller. Exposure is reduced faster. Risk is managed earlier rather than later. The market becomes less tolerant of surprises, because it has learned that surprises can arrive from places that were once considered irrelevant. This is where many people get the story wrong. They expect the end of the adjustment to look dramatic. They expect a final spike, a collapse, or a definitive resolution. In reality, the end looks quieter than the beginning. The volatility doesn't disappear, but it becomes purposeful. Moves happen for reasons that aren't obvious on the surface. Price action feels less emotional and more mechanical. Silver's role at this stage is no longer about supply headlines or geographic shock. It's about trust, trust in delivery, trust in timing, trust in the idea that paper claims will always align with physical reality. Once that trust is questioned, even slightly, it never fully returns to its previous state. It gets replaced by caution. That caution reshapes everything. Liquidity is still present, but it demands confirmation. Rallies are tested more aggressively. Pullbacks are treated with skepticism rather than relief. The market no longer assumes that pressure will resolve itself automatically. It waits to see proof. This is why the silver market may feel heavier going forward. Not weaker, heavier. Moves require more conviction. Reversals don't erase tension. And calm periods feel temporary rather than stable. These are all signs of a market that has internalized a new constraint. What's important is that this docent T means silver is broken in the sense of failure. It means silver is being repriced in terms of behavior, not just value. The way risk is expressed has changed. The way time is treated has changed. And the way participants react to uncertainty has changed. For those waiting for things to go back to how they were, this phase can be frustrating. The familiar patterns still appear occasionally, but they don't hold. Strategies that once worked reliably now worked inconsistently. That inconsistency isn't randomness. It's the result of a system operating under new assumptions. The real takeaway from this entire shift is not about Greenland or even silver specifically. It's about how fragile confidence can be when it's built on assumptions that are rarely tested. Once tested, those assumptions don't disappear, they evolve. If you've stayed through this entire breakdown, you're already ahead of most narratives. You're looking at how markets adapt, not just how they react. That perspective doesn't eliminate uncertainty, but it makes it easier to understand what you're seeing when things no longer behave the way they used to. I'd like to know what you're noticing now. Are reactions feeling faster? Are pullbacks less comforting? Are familiar signals less reliable? Drop your thoughts in the comments. These conversations matter most when changes are still unfolding. And if this analysis helped you see the bigger picture, share it with someone who's still waiting for a single headline to explain everything. Markets rarely change in one moment. They change in layers,